Hello and a very warm welcome to all the viewers of Crypto TV. This is Manoj Dara. So what are liquidity pools? Liquidity pools are not pools filled with water, but they are pools filled with money. The world of finance runs on liquidity. Without available funds, financial systems grind to standstill. DeFi or decentralized finance, a catch-all term for all financial services and products on the blockchain, is no different. DeFi activities such as lending, borrowing, or token swap rely on smart contract pieces of self-executing codes. Users of DeFi protocol lock crypto assets into these contracts called liquidity pools so others can use them. So how do liquidity pools work? We will tell you how. Well, for any economic activity to happen in a DeFi, there needs to be a crypto. And that crypto needs to be somehow supplied, which is exactly what the liquidity pools are set to do. Liquidity pools are smart contracts containing locked crypto tokens that have been supplied by the platforms and users. They are self-executing and don't need intermediaries to make them work. They are supported by other pieces of code such as automated market makers, which help maintain the balance in liquidity pools through mathematical formulations. So why is low liquidity a problem? We'll tell you how. Low liquidity leads to high slippages, a large difference between the expected price of token trade and the price at which it is actually executed. There is not enough liquidity or given trading pair, say for example ETH, to comp to all protocols. Those users will be stuck with tokens they can't sell. This is pretty much what happens with a rug pull, but it can also happen naturally if the market doesn't provide enough liquidity. How much liquidity is there in the entire DeFi? So liquidity in the DeFi is typically expressed in terms of total value locked, which is measured how much crypto is entrusted into protocols. As of April 2022, the TVL in DeFi was $222 billion according to the matrix site DeFi Llama. So you must be wondering, why provide liquidity to a pool? We will explain you. For investors, liquidity provision can be very lucrative. Protocol incentivizes liquidity providers through token rewards. These incentive structures has given rise to crypto investment strategies known as yield farming, where users move their assets across different protocols to benefit from yield before they dry up. So most liquidity pools also provide LP tokens, a sort of receipt, which can later be exchanged for rewards from the pool proportionate to the liquidity provided. Investors can sometimes take LP tokens on other protocols to generate even more yields. But beware of risk. However, liquidity pools are prone to impairment loss, a term for where ratio of tokens in liquidity pool, for example, 50-50 split of ETH versus the USDT, becomes uneven due to a significant price change that could result in losing your invested funds. Who is using liquidity pool? We will explain. So here are the three examples of the decentralized exchanges and the platform using liquidity pool. First on the list is 1inch, a decentralized exchange aggregator that works across multiple chains. Second on the list is Aave, a decentralized lending protocol. A third is Uniswap, a decentralized exchange for swapping Ethereum-based tokens. Now let's talk about the future of liquidity pools. The future of liquidity pools, which is operated in a competitive environment and attracting liquidity, is a tough game when investors constantly chase high yields elsewhere and take the liquidity. Nansen, a blockchain analytical platform, found that 48% of the real farmers who provide liquidity to a pool on the launch day exit the pool within just 24 hours. By the third day, 70% will be gone. To tackle this problem known as mercenary capital, Olympus DAO has experimented with a protocol-owned liquidity. Instead of setting up a liquidity pool, the protocol lets users sell their crypto into its treasury in exchange of its discounted protocol token, OHM. Users could stake OHM for high yields. But the model has run into a similar problem with investors who just want to cash out the token and leave for their other opportunities, diminishing the confidence in the protocol's sustainability. So the importance of liquidity pool in the DeFi ecosystem can be explained through the recent development in the Terra ecosystem, where the anchor protocol Terra's high interest saving accounted steadily started reducing the rate it offered to holders for depositing USD stablecoin. So investors started withdrawing money from the protocol, which resulted in the shutdown of the Terra blockchain. Crash on the Terra ecosystem and instead ripple effect led to the current crash in the crypto markets. So until DeFi solves the transaction nature of the liquidity, there isn't much change to the horizon of the liquidity pools. We will meet again with another episode of Deep Dive into DeFis. This is Manoj Dara signing off. Keep watching Crypto TV. Thank you so much.